Welcome to Daybreak Australia. I'm Haidi Stroud-Watts in Sydney, where markets have just come online.
I'm Annabelle Droulers in Hong Kong. We're counting down to Asia's major trading opens and the top stories this hour. Treasuries rebounding ahead of a record sale of 10-year bonds, with an auction of 3-year notes drawing solid demand. US-listed Chinese stocks rallying on bets for more forceful support from Beijing.
New York Community Bancorp sinks by double digits for the fourth time in 5 days as concerns about real estate exposure rattle regional US lenders.
Plus, Yum China jumping after fourth quarter sales beat estimates as the fast food operator rolls out new deals to lure cautious Chinese diners.
We do have some breaking news when it comes to South Korea's current account balance, and we are seeing these numbers coming through for the month of December. The goods trade surplus widening to just over $8 billion, and the December current account surplus widening to $7.415 billion there as well. In the statement just out, the services deficit at $2.54 billion for December. That is widening from the $2.21 deficit that we saw in November as well. So we are really seeing an increase across trade, across services, and of course that headline number there as well. That's according to data just out from the Bank of Korea. Let's take a look at how we're setting up across the rest of Asia in terms of these markets. And of course, we saw that rebound in particular when it comes to the bonds picture, and that is going to play through, particularly when it comes to the catch-up session that we see for Australian bonds this morning as well. That Treasury's rallying before that record 10-year bond sale. But take a look at the setup when it comes to equities. We're seeing the start of cash trading, the staggered beginning of the session here in Sydney. We're seeing a little bit of upside, about 1/10% there. We're seeing also that picture across Australia, 3 and 10 years as well. The Aussie dollar holding pretty steady, 65. Up 27 is where we're trading. And of course, some of the sort of repricing against expectations from the RBA as well, as we heard. Inflation fears may be starting to come to a little bit of an end. The Bloomberg economics analysis certainly saying that the RBA's hikes are done, but still a bit of uncertainty as we will start to see the start of easing to come in the next part of the cycle. This is what we're seeing across the rest of the region. Kiwi stocks are up by just about 1/4%. We're seeing Chicago Nikkei futures a little bit muted at this point. A dollar yen holding pretty steady at that 147, just shy of the 148 level. We did see the dollar reaching the highest really since November during this week, as those bets on rate cuts from the Fed really are getting pushed back, Belle.
Yeah, that's certainly the recalibration that we're continuing to see here in markets. But just take a look at some of these big moves we are seeing today in after-hours trade, because earnings continues to be that dominant theme as well for the US session. Taking a look here at Ford, for instance, we saw that company beating expectations. It is seeing more profit growth ahead, which is interesting at the same time that it's actually seeing EV losses, rising labour costs. So it was able to offset those. Another one of really standing out today is Yum China here. So that one is jumping in post-market. So this is Chinese or catering to Chinese consumers with fast food restaurants, and it saw same-store sales beating the average analyst estimate. To note as well, you can see that we're going to have a big interview with Joey Watt, who is the Yum China CEO, coming up in about 3 hours' time from now. Snap to the flip side here. I mean, that is a very disappointing move we're seeing in after hours here. So not great numbers coming out for the holiday quarter, and it is continuing to see that weakness in the digital advertising market. So just a few names that we're really tracking here in after-hours trade. But broadly in the session, if we take a look at what's happening for futures right now, you can see that they are fairly steady so far, though we did see that move higher into the close. Bonds as well, you mentioned, we saw those climbing following the recent sell-off. And that was despite what's been a continued drumbeat of Fed officials that are just echoing Jay Powell's message here. They're not in a rush to cut rates. Here's what the Fed Bank of Cleveland president Loretta Mester had to say.
It would be a mistake to move rates down too soon or too quickly without sufficient evidence that inflation was on a sustainable and timely path back to 2%. If the economy evolves as I expect, I think we will gain that confidence later this year, and then we can begin moving rates down.
Let's get more on that now with our first guest, Adrian Yamaki, founder and financial advisor at Strategic Wealth Capital. So, Adrian, thanks so much for joining us this morning. You heard it there, that continued pushback that we're getting from Fed officials, even though we continue to see assets like stocks, for instance, trading on the expectation of cuts. How much disappointment are we setting up for here?
We're looking, as Powell said on Sunday, they're very cautious, and I think it makes a lot of sense if we think about the last couple of years and just how quickly rates came up. It's very sensible that they're being very cautious. Interest is still they're going to keep it at 5.5. It sounds like in March it's very unlikely that we're going to have a cut. The FOMC is targeting about 2% for inflation, and it's about 3.4. So I think it's right that they'll be cautious. I think the markets are waiting a bit to see what will happen. But in the longer run, it's really more about which types of industries and which sectors will benefit from falling interest rates. And so the short-term speculation is what it is, but we're really looking at, okay, what will this really change in clients' portfolios and who benefits from dropping interest rates?
Yeah, so just give us more details on that. When you do think strategically about it, which sectors or areas are you preferring?
So we have to think about what the environment we're in. So right now, profits are accelerating, profits are improving. Last year, a lot of analysts were considering whether we were entering a recession. It looks like that's less and less likely. So we have improving profits. The FOMC is pausing for interest rates, but it looks like sometime between now and the end of the year, it's probably going to be maybe 25 basis point, maybe 50. It's going to happen. It's just a matter of time. And the industries that benefit there are quite a few. One specifically, I work with a lot of financial services professionals, banks. So large banks, smaller bank, regional banks, international banks benefit when rates come down. If we look at the portfolio of banks, they're a big part of it is net interest income. That improves when interest rates come down. Also, if we just look at loans, so business loans, that activity, when that increases, the business loans and the amount of activity also increases. And then, of course, we know in the U.S. we're looking quite a lot at mortgage rates. And it helps for two different reasons. One is, of course, as rates come down, as mortgage rates come back down, more homeowners are able to afford purchases. But also, we had something unusual this last couple of years, which is supply has been, let's say, a bit sluggish. A lot of owners who had locked in lower rates have been sitting on their homes and waiting for rates to come down so that they could also move. So the inventory has also been very low. And the beneficiary of all of this change and all of this movement is financial services.
Adrian, I find it interesting that you've been sort of so focused on banks, right? Because we have seen that as an early theme emerging this year. What we've seen in Azora in Japan, of course, what's going on with NYCB at the moment, extending that route. Are you concerned that there's more downside pressure and stress to come in terms of the exposure within some of these portfolios?
There are a couple of things that will serve as buffers. The first is just valuation. So valuations for financial services have been much more repressed. They've been a lot lower. So there is risk, but it's always about how much am I going to be compensated for this risk? And the lower the valuations are and the lower you pay for, and the more buffer there is, as they regress to the mean, the better off you are. So because of valuations, that's less of a concern. And also for a lot of international banks that have, for example, large percentages in investment banking and M&A activity, falling interest rates, whenever that does happen, certainly benefits those parts and departments of the bank as well.
Let's talk about international. You remain bullish on international. Where are you seeing the spots for best opportunity?
International is very similar because of valuations. So last year, large US performed extremely well. And it's not an anomaly. If we just look at the last 14 years, US large cap has outperformed international, emerging market, international blue chip, international developed. And the US is trading at a very large premium. So could it continue the next decade? It could. I've been saying for a long time that because of valuations and because of growth and because of a US bias that both individual investors and institutional investors have, that's not going to, it's not going to persist forever. It's going to have to come up, the prices are going to have to come back to reasonable valuations.
Adrian, great to have you with us. Adrian Yamaki, founder and financial advisor at Strategic Wealth Capital. Ahead on Daybreak, hope rises that a hostage deal between Israel and Hamas could be reached soon. We get the latest developments next. This is Bloomberg.
Hamas responded tonight. We're reviewing that response now, and I'll be discussing it with the government of Israel tomorrow. There's still a lot of work to be done, but we continue to believe that an agreement is possible and indeed essential, and we will continue to work relentlessly to achieve it.
US Secretary of State Antony Blinken there speaking in Doha following a proposal to halt fighting in the Gaza Strip in exchange for the release of some Israeli hostages. Well, Qatar, of course, a key mediator to end the conflict, says Hamas has sent, quote, a positive response to the plan. For more, let's bring Bloomberg's Michael Heath. Are there some hopes that this could get done?
Yeah, I mean, look, it's better than an outright rejection, Heidi, obviously. And I think it speaks to a couple of things. Hamas is probably under a degree of pressure. The people of Gaza obviously have suffered horrifically, and there are reports of people saying out of there that, you know, that basically that benefits Hamas, but they're the ones paying for it. So they have to be mindful of that, and probably militarily they're under quite a lot of pressure after, you know, 3-4 months of war. So that's positive, and the potential repercussions of that would be that, you know, if we do get some sort of deal, perhaps the Houthis then stop attacking in the shipping that's going past there, and that pressure eases off, and as well as Hezbollah. So there's a lot at stake here, but you know, Israel again, we'll probably get to this a little bit later, but Prime Minister Netanyahu doesn't have a lot of room to manoeuvre. Hamas is probably wanting quite a lot. President Biden described some of the suggestions in their proposal as over the top. So you know, it's good baby steps, but we've still got a bit of a way to go there.
Yeah, I think maybe what you're referring to there or indicating, Michael, is about Netanyahu's relationship with some of his far-right ministers who have been attacking the Biden administration. So how does that exactly complicate this process?
Yeah, it's really interesting, Annabelle. I mean, the two representatives mentioned, or the ministers in the cabinet, they're almost fringe politicians in a way. I mean, they're very much representatives of the settler community. There was criticism of Biden for the US administration blocking the bank accounts of settlers engaged in violence in the West Bank, which obviously makes things even more tense outside of Gaza, where there's, you know, terrible bloodshed at the moment. And also that a second minister also said that President Trump would be better for Israel than Biden, which is a bit of a slap in the face, given that, you know, President Biden has stood pretty staunchly by Israel, despite a lot of angst and unrest in the US over just how tightly the US has tied itself to Israel and to Netanyahu. It's an interesting point. Netanyahu needs these these parties' support in order to keep his government majority, but by the same token, they need Netanyahu in order to be able to direct funds to their supporters and that sort of thing. So it's not that they can really hold the government to ransom. He does have some room to manoeuvre there. It's really, but it does give him an excuse to when talking with the US as well, that, oh, I can't move because of these ministers in my government. But he does probably have a little bit more room for manoeuvre than he lets on sometimes. He's a very wily politician, is the Prime Minister of Israel.
Very interesting, Michael, but also seems like a very delicate balancing act as well. That was Michael Heath there in Sydney. Let's also get the latest in politics now. And President Biden is blaming Donald Trump for sinking a bipartisan bill linking border controls with military aid for Ukraine. The president admitted the Senate package is unlikely to move forward and says he'll use the issue against the Republican frontrunner on the campaign trail.
All indications are this bill won't even move forward to the Senate floor. Why? A simple reason. Donald Trump. He'd rather weaponize this issue than actually solve it. So for the last 24 hours, he's done nothing, I'm told, but reach out to Republicans in the House and the Senate and threaten them and try to intimidate them to vote against this proposal. And it looks like they're caving.
Meanwhile, a U.S. federal appeals court has rejected Donald Trump's argument for presidential immunity, moving him closer to prosecution for allegedly trying to overturn the 2020 election. The case brought by special counsel Jack Smith's office is one of 4 criminal cases Trump is facing, including a similar election case under state law in Georgia. His campaign says that he will appeal against the D.C. Circuit Court ruling.
Another story that we're following closely, the former Chilean president Sebastián Piñera has been killed in a helicopter crash. Reports say the 74-year-old was piloting the helicopter when it came down in the country's south. 3 other people on board survived. The Harvard-educated billionaire served 2 terms as president between 2010 and 2022. The government has declared a period of national mourning. More to come here on Daybreak Australia. This is Bloomberg. US Treasury Secretary Janet Yellen says losses in commercial real estate are a concern, but regulators are working to ensure the financial system can cope. She was speaking at the start of 2 days of congressional testimony. Yellen cited a combination of factors, including high interest rates and vacancy rates, and a wave of commercial real estate loans that are coming due this year.
I do have a concern about commercial real estate. I believe it's manageable, although there may be some institutions that are quite stressed by this problem.
Shares of New York Community Bancorp has tumbled by double digits for the 4th time in 5 days, extending a rout triggered in part by those concerns over US commercial real estate. For more, let's bring our US regional bank reporter, Diana Lee, who joins us out of New York. And Diana, so what are all the sort of contributing factors that's driving this extended slide now?
Yeah, so commercial real estate loans have been a concern since COVID, when work from home policies continue to weigh on the commercial property values. But what triggered this round of sell-offs of Community Bank is that when this bank reported earnings on January 31st, it kind of splashed its dividends and stockpiled a lot of reserves that intensified the market fear. And what is special about New York Community Bank is that it is actually one of the winners of last year's regional banking crisis, when it acquired loans from Signature Bank that pushed up its asset over $100 billion, which also made it subject to more regulatory scrutiny in terms of its liquidity and in terms of its commercial real estate concentration. And the company also reported 2 charge-offs in its commercial real estate loans. One is office, another one is a co-op loan, both are in New York. It also has some exposure to the rent-stabilized loans in New York, which is subject to a lot of regulations that kind of adds to the concerns we're seeing here.
Yeah, we just heard from Janet Yellen there expressing some concerns about commercial real estate. But what else are we hearing from regulators, and as well the 2 NYCB executives that just left?
Yeah, so one thing to keep in mind is that New York Community Bank almost doubled its size over the past 15 months, thanks to its acquisitions of Flagstar, its mortgage unit, and its takeover of the Signature Bank loans. So because of that, it attracted some regulatory pressure from the banking regulator, OCC, which has been exercising some control over its dividend payout after the acquisitions. And we have a story yesterday about the bank's chief risk officer and its chief audit officer left before the specific measures with the regulators are reviewed. Right now, we do not know if the management pushed them out or if the regulators prompted them out or they just simply choose to leave. But it's just very interesting to see it happening from a risk and compliance perspective.
We're still haunted by what happened with SVB last year. Should we be looking out for more risks? Is there depositor outflow pressure like we saw with SVB? And we've seen, a similar pressure with Azora in Japan, right? Is this a bigger kind of picture situation when it comes to risks within these portfolios?
So right now, the company didn't share any details on the deposit outflows. So we're also waiting for more clarities on that. But when we look at its balance sheet, it does seem a little bit vulnerable because a third of its deposits are uninsured by the FDIC. And it has been relying on the broker deposits to beef up the liquidity. And apparently a lot of the money is the demand deposit accounts, which can be withdrawn at any time without notice. And another thing we're closely watching is any activities in the bank's balance sheet management, meaning is the bank going to sell off some line of its business or shrinking its bond or loan portfolios or do some sort of the credit risk transfer with private equity or hedge fund that can help them inject some capital.
I want to track pretty closely. That's our US regional bank reporter, Diana Lee in New York. And another bank as well that we're tracking very closely is New York traded shares of UBS because they fell the most in 11 months overnight, even as the lender announced $1 billion buyback with fourth quarter earnings missing estimates. CEO Sergio Amotti told us the bank is willing to sacrifice growth in order to improve returns as the merger with Credit Suisse concludes.
Is a pivotal year because if you think about the journey, the first 6 months are very intense. I think we're going to go through the merger of the two operating entity, UBS and Credit Suisse AG will merge in the first half of the year. The subsidiaries in the US and Switzerland will merge also during 2024. So this is the prerequisite to be able to realize our synergies. We already achieved 4 billion of cost savings, exit rate 2023. We now plan to have another gross savings of 9 billion between 2024 and 2026. Partially, this will be reinvested in the business to make our platform more resilient and up to speed with the requirements, but also to invest in our future.
So, Sergio, how important was this investor update just to give a blueprint of the kind of growth that you want to attain and how?
I think it's very important for investors to understand how we are connecting the dots between what we said in summer last year and in respect of our long-term plans, in 2026 plans and going beyond that. So today we are providing few dots between 2024 and 2026, how we achieve cost savings, how we manage our balance sheet, how we want to manage growth that has to come in a sustainable way. And also we give also some indications about what to look forward after the completion of the restructuring, which is then going to enable us to harvest, the work, and we did with a quite attractive returns.
UBS CEO Sergio Amotti there speaking to Bloomberg's Francine Lacqua in Zurich. Well, coming up next, we'll be talking about bond investments, where we're at in terms of expectations for this year. Alliance Bernstein is along with us. Brad Gibson coming along with us to talk about these opportunities as traders gear up for a record $42 billion sale of 10-year treasuries. This is Bloomberg.
The last 3 to 6 months has been surprisingly good news. Again, I don't want to say we're done yet. I don't want to say we're necessarily going to just glide past all the way to 2%, but fingers crossed, the data is looking positive.
Minneapolis Fed President Neil Kashkari there on how the Fed has not yet reached its inflation goal. And despite last year's big bond rally, our next guest thinks 2024 will be more about how far and how fast bond yields can fall. Alliance Bernstein, head of Asia Pacific Fixed Income, Brad Gibson, joins us now. Brad, it's already been a pretty interesting start to the year, and certainly over the past couple of days when you've been watching global bonds. But if you take a look at this chart, it actually kind of surprised me to see that despite the moves that we've seen, certainly in recent trading sessions, that volatility is actually pretty close to a multi-year low, and certainly the move is not too far off its multi-year support levels either. So how are you, I guess, structuring the narrative for treasuries and for broader bond markets going into this year?
Yes, good morning. It is interesting, isn't it, that we do see some fairly large intraday ranges, yet overall the market's pricing of forward volatility is still quite well contained. And so there is kind of a comfort level in the US Treasury market about the Fed beginning its rate cutting cycle somewhere in the second half of this year, and yields gradually declining. So that fairly sort of Cinderella environment for the bond market is what's dominating certainly the options market, with volatility remaining at low levels. Whether the Fed cuts in March, June or later in the year, for a longer term investor, maybe not that important. The direction is important, and that is lower, and bond yields are going to be supported in that environment.
Where do you see the best opportunities then?
Yeah, so again, as you said, the yields are going to be lower, so probably heading towards 3.5% by the end of this year. So there's some gains to be had by just owning longer dated bonds, and particularly maybe the shape of the yield curve. Again, as central banks begin to cut rates and support the levels that are implied in the shorter end of the curve, we could see yield curves steepen across a range of markets, not just in the US, but in markets such as Korea, and even in China, where we are seeing potentially further easing.
Just picking up on China there, because how closely are you tracking those moves? We've seen those bonds really moving in anticipation of some sort of easing there.
Yeah, we're tracking that very closely. We enjoyed the rally in China bonds in the last 6 months, but have turned a little bit more cautious just given the level of where rates got to, and think that maybe there's a bit too much of a long position in that market that could be quite easily unwound if we continue to get more sort of stronger support for economic activity from policymakers in the next couple of months. But that to us would be an opportunity to probably go and re-engage with a long position in the Chinese market. Growth in China is structurally going to be slower. There is no inflation there, so real yields look relatively attractive. So for a longer term investor, investing in the China bond market will continue to pay off.
What about Aussie bonds? Would you shy away from owning those, given that the RBA was a little bit more hawkish yesterday?
The fundamentals for Australia are quite strong. So yes, you would think that maybe the RBA is going to be one of the last of the developed market central banks to need to start cutting rates. But nevertheless, because there is so little priced into the short end of the yield curve in Australia, maybe 40 or 50 basis points of tightening versus 150 in other markets, there is a tail risk here that the RBA could be dragged and screaming to ease rates sort of faster than what the market's anticipating. So whilst we agree that inflation, etc., is still elevated and the RBA is not likely to cut anytime soon, there is a risk to being underweight Australian bonds because there is just so little priced in compared to other markets. And when we hedge Australian bonds back to a base currency like the US dollar, that yield actually looks quite attractive.
One of the sort of risks, certainly for Australia, but also across EM, is the fate of China this year, right? And you don't expect to see a solid stabilisation for the Chinese economy. It's interesting, though, have we started to see a decorrelation between what happens in China and the rest of the EM complex, or do you think that will still be a fundamental driver for EM bonds this year?
It's a good point, isn't it? Because if we'd experienced what China's growth has been in the last 12 months, we would have expected emerging markets to probably have underperformed more than they have. And I think that there is sort of a move to other markets. I think markets like Indonesia and India seem to be benefiting from corporates and other entities looking to reinvest in markets away from China. So the impact of China's slower growth at this stage doesn't seem to have had as big a negative impact on emerging markets than we would have previously experienced. And because there is so much fuel for large DM central banks to cut rates should things deteriorate, I do think there is a bit of a backstop to emerging markets going forward.
What about another sort of risk on the horizon? And this is more in the political realm, because we've got the US elections that are coming up in November. How are you pricing around that?
Yeah, I think that's going to be a sort of a story for the second half of this year. And if you look back at sort of what US policymakers decided following Trump's election, etc., whether it's a trade war or the imposition of higher tariffs, there will be likely reactions there. So if we do see that escalation, then maybe currencies like the renminbi or the Australian dollar could be under short-term pressure as we get a reaction to that. Again, that volatility, that political volatility, is probably likely to support bond markets and allow central banks to backstop economic growth with further easing. So again, we sort of go back to sort of being sort of overweight bonds and adding to that overweight position, and reasoning for it is that political risk that's emerging.
That's Brad Gibson, head of Asia Pacific Fixed Income at AllianceBernstein there. And other stories that we're tracking right now, DBS has reported fourth quarter profit that missed expectations amid signs of pressure on margins. Net income rose 2% to 2.39 billion Singapore dollars, which was just below the average estimate. The lender says variable pay for the management team has been collectively cut by 21%. That's due to a spate of digital banking outages, including a deeper 30% pay reduction for CEO Piyush Gupta. National Australia Bank says Andrew Irvine will replace Ross McEwen as Chief Executive Officer. Irvine's been NAB's group's executive for business and private banking since 2020. He'll start in the role on April 2nd, when McEwen will retire from executive roles after more than 4 years in charge. The SEC is set to label hedge funds and proprietary companies that regularly trade US Treasuries as dealers, bringing greater compliance costs and scrutiny. The market regulator is boosting oversight as the firms become increasingly responsible for liquidity in the world's biggest government bond market. Funds will get a year to comply with the registration requirements. And we'll have more ahead on Daybreak Australia. This is Bloomberg. You're watching Daybreak Australia. Just taking a look at some of these huge moves and after hours here today. Snap is just absolutely standing out here, down more than 30%. This is all down to earnings, of course, after the bell today, but disappointing revenue coming through for that social media company in the holiday quarter. It is continuing to struggle with that slump in the digital advertising market, so that's really playing into Snap's numbers there. What else we're tracking in the session is Ford. You can see there rising after hours. It's been pretty interesting for this automaker, because they're actually grappling with a pullback in electric vehicle purchases and also rising labour costs. But to counter that, they're increasing their output of gas vehicles instead, and that's what investors are really liking. So we are seeing Ford able to sort of counter those losses in other parts of the business. Yum China, one to note here, because we are seeing that absolutely jumping in after hours trade today. So this is an owner and operator of fast food restaurants in China. It posted same store sales that beat the average analyst estimate for the fourth quarter, and a big interview coming up in a few hours with the CEO of Yum China. But we'll get more on Yum China now, because we've actually got our Bloomberg Intelligence Senior Consumer and Technology Analyst, Catherine Lim, joining us. And Catherine, just talk us through the headline here. What stood out to you in those Yum China numbers?
Well, you know what? The sales actually beat what we were looking at. So that was a great delivery for a quarter that we've actually seen a lot of discountings and promotions, but Yum China did well. And specifically, I'd like to actually highlight the margin resilience, which actually surprised, on the upside. So overall, looking forward to the guidance that the company will be giving in about 20 minutes' time as they hold their results call.
When you take a look at Alibaba, what are some of the expectations or maybe some surprises that can support the gains that we've seen across the share price over the past couple of sessions?
Right, indeed. That's another set of results that we will be closely watching tonight. I do think that, given the expectations have been downwards revised over the last quarter, we're looking at cuts of more than 10%. I do think that there is some room for the company to actually beat on the adjusted EBITDA basis, particularly, I think, as the company delivers, better than expected performance for some of the China consumer businesses, such as the Taobao and Tmall Group, as well as local services.
Yeah, Alibaba, as you said, really trying to focus on its core business operations. So do you think that means that it's looking to sell any sort of assets? Because that was reported by media early this year.
Right. The company talked about it in the last quarter results that, it will look at opportunities to dispose of non-core assets. And clearly, I think offline retail, such as, department stores, physical supermarkets, is not something that will actually drive the tech focus for the new CEO. Now, subjected to market conditions, I think when that turns more favorable, there definitely will be the opportunity for them to actually cash out of these assets.
Bloomberg Intelligence Senior Consumer and Technology Analyst Catherine Lim there looking ahead to Alibaba. And of course, we'll be speaking exclusively to Yum China CEO Joey Wat about those latest numbers and the outlook. That's coming up at 1 p.m. Sydney time, 11 a.m. if you're watching in Hong Kong. Well, the Japanese parent of the world's biggest convenience store chain, 7-Eleven, is targeting growth in the market where the brand began a century ago, the United States. 7&i Holdings says it will use its Japanese retail and supply chain expertise to transform the home of the American Slurpee and Big Gulp. Stephen Engel reports from Tokyo in this Bloomberg exclusive.
He may be the rice ball king of Japan, but Ryuichi Isaka wants much more for his 7&i convenience store empire that spent at least $25 billion over the past 7 years expanding its global footprint. Isaka runs the ubiquitous 7-Eleven business, born in America but now controlled out of Japan, where the kombini, as these mini-marts are known, are a part of daily life.
This is nearby my office, so I come here every day.
Every day?
Every day?
Yeah, yesterday, day after tomorrow, yeah.
Sure, 7-Eleven may sell 2 billion traditional rice balls or onigiri each year, but it now cycles in some 2,500 new food items annually. Japan is aging, women are working more, households are shrinking, and tastes are changing. Fresh food now takes up about a quarter of shelf space.
In response to these market changes, we believe in order to grow, we need to keep changing our product lineup. I prepared something I like. Korean barbecue is popular now. Yes, it's a new product.
7-Eleven claims to be the world's largest convenience store operator, with nearly 23,000 stores across Japan, 85,000 around the world, everywhere from densely populated Tokyo to more remote Taoyuan, Taiwan, where there are 6,800 convenience stores, including the one behind me, which is known more as a hybrid store, a larger convenience store where you can get just about everything. And this particular store in Taoyuan, it is store number 6,711. Worldwide, 7-Elevens are in 20 countries and regions with the aim of adding 10 more by 2030. The key to growth, though, may lie in its birth market, the United States, where 7-Eleven is the leader, but still only has less than 10% of the overall 150,000 store market. Recently, it bought the American gas station stores Speedway and Sunoco, betting that 7-Eleven's Japanese know-how will help transform these roadside pit stops.
We believe that we need to change our business model from one that relies on gasoline and cigarettes to one in which customers choose us based on our products. The key to this change is fresh food.
And a reliable supply chain in the United States. This Fuji Foods onigiri plant outside Tokyo, for example, is the picture of sanitation. We had to roll,
scrub, a double glove.
They are serious about cleanliness.
As if we were entering a semiconductor plant. Assembly lines run 24/7 to meet demand.
And within 12 hours of this being made, these other onigiris will be on the store shelf in 7-Elevens across Japan.
Okay, they might need to alter the food offerings to better suit American tastes, as well as perhaps eventually change the corporate structure to better suit shareholder demands. San Francisco-based activist investor Value Act Capital Management is pushing Seven & I to split off its non-core operations like underperforming department store Ito Yokado to unleash growth for 7-Eleven. So far, Isaka has resisted.
If we are to transfer the growth of 7-Eleven Japan to the rest of the world, we must transfer the success of 7-Eleven Japan's food business as well. If we simply increase the number of stores, we will be building a tower on a very weak foundation.
That foundation, built nearly a century ago as an ice vendor in Texas, may have to rely on its Japanese success to build upon its lead in a fragmented American convenience game. Stephen Engel, Bloomberg News, Tokyo.
We do have breaking news when it comes to some developments in U.S. politics. The House has held a vote on Homeland Security's Mayorkas impeachment, and that House vote has been rejected in terms of the impeachment vote. We did know that a panel of Republicans were planning to barrel ahead with this vote that approved plans to impeach the Homeland Security Secretary Alejandro Mayorkas. It is really seen as a historic vote on the House floor, as critics have been denouncing that effort as being unfounded, and now we are seeing that the House lacks the votes to pass the standalone $17.6 billion Israel aid bill as well. We are seeing that vote ongoing, but when it comes to the vote to impeach Homeland Security Secretary Mayorkas, that has been rejected. This still would have made him the first cabinet official to be impeached in almost 150 years, but it was virtually certain that, of course, the Senate, which is led by the Democrats, wouldn't be voting to remove Mayorkas, but still a significant action, giving Republicans the ability to aggressively oppose the secretary, who is increasingly coming under scrutiny and criticism for the handling of the southern border. Our coverage continues here on Daybreak Australia. This is Bloomberg. Well, demographic struggles are changing the face of Japan's workforce. A record 2 million foreign workers entered the country last year, and more are needed to plug a labour shortage. Our Japan economy and government reporter Erika Yokoyama joins us now from Tokyo. And Erika, you know, the demographic challenges and shifts for Japan are well documented, and we know that this is one of the areas in need of structural reform. Is it visible in terms of daily life in the country?
Actually, it's not so visible in city centers like Tokyo, but in the countryside, it's more evident that the number of foreign workers is increasing. This time, I had a chance to visit two local cities, Oizumi in Gunma and Onomichi in Hiroshima Prefecture, where I encountered people of diverse nationality working at construction site, farms, and factories. And those areas matches the areas that Japan faces the most serious labor shortages and aging of working population. So the mass inflow of foreign workers is not necessarily visible, but foreign workers are increasingly filling the labor gap to support regional economy.
And so what are the types of reforms that government and companies are using to try and attract those foreign workers to Japan?
Right. So competitions for foreign workforce is getting more and more intense within the country as the labor shortages gets more serious. And so local governments and companies need to improve themselves to attract and retain foreign workers. Then some local governments put a massive efforts into it. For instance, like they assign translators at city halls and host seminars to give some advice to companies looking into hire some foreign workers. And company as well, like an an oyster processor that I visited in Hiroshima told me that the company is providing work manual in Vietnamese and put signs with illustration warning danger in the factory.
That was our Japan economy and government reporter Erika Yokoyama there. And Heidi, big news out there for anyone that's a Swiftie fan in this part of the world, because Taylor Swift, she's back. She's resuming her Eras tour. She's coming to Tokyo this week. And of course, we're just always about calculating the costs that are associated with this. Just how much more revenue can she generate on things like tickets, merchandise, food, hotels, other related activities. But now we've actually got the calculation coming through for the Japan part of the tour. It's come from someone who's a lecturer at Tokyo City University, and he's saying that Taylor Swift, these 4 concert dates, it's going to be generating $230 million. That is a huge amount of money to be generating just over a couple of different events, especially because, as we understand, Japanese people only listen to a limited number of songs in English, but certainly something to be tracking very, very closely for those fans of Taylor Swift in this part of the world. And the question mark whether she goes back to Las Vegas as well on Saturday.
Oh, there's just so many different types of analysis on this, right? And, you know, I'm a moderate Swiftie, I will give you that. But certainly I think we also have possibly Australia's biggest Swiftie right here in the office next to us with one of our producers giving us all of this analysis and information. But it's interesting. I saw a headline yesterday covering the RBA was saying that Governor Bullock, you know, perhaps sounding hawkish because of the potential inflationary spike that we could see as a result of the Taylor Swift effect, right? As you've just spoken about in terms of hotel pricing, you know, travel pricing, services and other related activities. So it's very interesting, and it's interesting as this tour, of course, heads to Australia. We're seeing hotels being booked out, and we've seen this kind of being modelled across just about every city and every stadium that Taylor has performed in, right? For Tokyo in particular, it kind of cements its appeal for many popular Western artists: Coldplay, Billy Joel, John Mayer, Bruno Mars and Ed Sheeran in recent months. And yep, another reason to travel the world and see Taylor.
Yeah, just bring your attention as we close out the show here. The US House rejecting a standalone $17.6 billion Israel aid bill. We had seen them voting on that. More details ahead.